Bang! Hey gang, I'm Dr. Who. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough problem on how to properly record transactions for selling and purchasing inventory. So if you're unfamiliar with inventory, don't fret gang, I dropped a link for you to get up to speed with no time. So with that being said, let's get it. So it wants us to journalize the following transactions that occurred in September for waterworks, assuming a perpetual inventory system is being used. No explanations are needed. Identify, yada, yada, yada. Estimate sales return at the end of the month. Alright, gang. So they want us to do some journal entries. So in this particular problem, we're going to journalize the selling side and the purchasing side of inventory, which is very critical for you to understand because the journal entries change significantly. So with that being said, let's rock and roll. So it tells us on September 3rd, we purchased merchants inventory on account from Shaolin wholesalers for $5,000. Turns $315 at end of the month. Free aboard shipping point. Easy breezy, gang. So let's identify the keywords. We purchased some inventory on the account. So we're on the purchasing side of inventory. Therefore, we're going to debit merchandise inventory and credit accounts payable Shaolin for the $5,000. We're going to check our answer. Good job, gang. Moving on. Next, it told us that we paid freight bill of $70 on September 3rd purchase. Again, keywords, paid freight bill, purchase. So we're on the purchasing side and we paid for some freight bill. Now, gang, we are purchasing inventory. And if we're paying for the freight bill, meaning the shipping charges, we must consider this freight in. Why? Because freight in by definition is any shipping charges that you pay for to get the goods into the business. Henceforth, freight in. And we know that freight in is included in inventory, which means that it's going to increase the cost of our inventory, which constitutes a journal entry to debit our merchandise inventory for $70 in credit cash. We're going to check the answer. Good job, gang. Also on September 4th, we purchased merchandise inventory for cash $2,400. Easy breezy, gang. We're going to debit merchandise inventory and credit cash for $2,400. Check our answer. Fantastic. On September 6th, we returned $1,200 of inventory from September 3rd purchase. Okay, gang, so we're still on the purchasing side, and this is considered a purchase return. And anytime that we have a purchase return, that thus reduces the cost of our inventory. Remember, one key fact about inventory is that it's always on the books at cost. So any purchase returns, any allowances, or any discounts on the purchasing side will always affect, thus reduce the cost of our inventory. And since September 3rd purchase was on account, we're going to debit accounts payable for Shaolin and credit inventory for $1,200. We're going to check our answer. Nice work, gang. September 8th, sold merchandise to Hilton Company, $6,200 on account. Terms $315, net $35. Cost of goods sold is $28.52. All right, gang, we are dealing with the selling side finally. We know whenever we sell inventory, we have two transactions that must be addressed. One to account for revenue and two to account for our cost of goods sold. Now, always gain to account for revenue, we must identify the larger amount between the two, obviously because we never sell inventory at a price below its cost. We also, since we're on the selling side, must consider the fact that we are going to assume that the customer is going to take advantage of the discount, meaning that we are going to record this initial sales revenue at the net discounted amount, thus taking the $6,200 and subtracting 3% from it. Remember, the discount terms basically means for this particular problem that we're giving a 3% discount to our customer if they pay within 15 days. Therefore, for this initial sales transaction, we are going to debit accounts receivable Hilton and we're going to credit sales revenue for the discounted amount, which is going to be $6,014. We're going to check the answer. Good job, gang. But we're not finished. We have to recognize the expense from selling our inventory, which means we're going to debit cost of goods sold and credit merchandise inventory at cost gain of the $28.52. We're going to check our answer. Well done. September 9th, purchase merchandise inventory on account from Taylor, $7,000, $210 net, $30, free aboard destination. Okay, gang, we're now back on the purchasing side. We're buying from Taylor this time for $7,000 on account. So we're going to debit merchandise inventory and credit accounts payable Taylor for the $7,000. We're going to check our answer. Well done, gang. September 10th, made payment to Shallon wholesalers for goods purchased on September 3rd, less return and discount. So a lot's going on, gang. So now we are making a payment, right, on our account, which means we're still on the purchasing side. We're making a payment to Shallon wholesalers. So we have to go back and recognize how much was initially bought from Shallon wholesalers. And we also must consider the fact that we made a return earlier, as well as we're making this payment within the discounted time frame. How much did we initially purchase from Shallon? $5,000. Then on September 6th, we made a return for $1,200, thus decreasing our accounts payable. So if we subtract $1,200 from $5,000, that will tell us exactly how much we owe, which is a total of $3,800. But remember, gang, we made this payment within the discount terms, which means that we're actually not going to pay the cash amount of $3,800. We're going to pay the cash amount of $3,800 minus the discount. Nevertheless, when it comes to reducing our accounts payable, we must debit accounts payable at the full amount of the $3,800. Likewise, we're going to credit the cash amount of $3,800 minus 3%, which will give us a total of $3,686. But we're not quite done yet, gang. Why? Because since we received the discount, we must also reduce the cost of our inventory via a credit to inventory for that discounted amount, that 3% amount. So we're going to credit merchandise inventory for the discounted amount of $114. We're going to check the answer. Excellent job. On the 12th, we received a payment from Hilton less the discount. So all right, gang, we flipping and flopping. Now we're back on the selling side because we are collecting on an account within a discount term. But remember, gang, when we're on the selling side, we automatically adjust our revenue upon the initial sale transaction, assuming that the customer is going to take advantage of the discount, which means that this collection on account has already been netted for that amount. So initially we recorded the net amount of sales revenue of $6,014, and since the company actually did pay us within that discount amount, we're going to reduce accounts receivable for the same amount. Thus, debiting cash and crediting accounts receivable for the $6,014. We're going to check the answer. Excellent job. September 13th tells us after negotiations, we received a $250 allowance from Taylor wholesalers. So gang, question of the day, who received the allowance? Us. If we received the allowance, that means we are on the purchasing side. Therefore, this is an example of a purchase allowance. And remember the rules. Anytime there's an allowance on the purchasing side, it will reduce the cost of inventory. Thus, this transaction will affect inventory as well, gang. So we're going to debit accounts payable and credit inventory for that allowance amount. We're going to check the answer. Excellent job. September 15th, sold inventory to Julian for $3,300 on account. Terms net a month. Cost of goods sold is $1,485. All right, gang, we are now on the selling side, and I feel that you guys are finding a method to this madness. So we're going to debit accounts receivable Julian and credit sales revenue for the net amount. But wait, there's no discount terms. So the net amount is the gross amount as well. which means that we're going to simply put in the 3,300, gang. We're going to check the answer. Good job. Let's not forget that we have to account for inventory, so we're going to debit cost of goods sold and credit merchandise inventory for the cost of $14.85. We're going to check the answer. Beautiful work. On the 22nd, we made a payment less the allowance to Taylor wholesalers for the goods purchased on September. So if we think back to the earlier part of the month, September 9th to be exact, we had purchased inventory for $7,000 from Taylor, but we also received an allowance for $250. Thus, we're making this particular payment now, so we're going to debit accounts payable and credit cash for the $6,750. We're going to check our answer. Nice work, gang. The 25th, we sold merchandise inventory to Shelter for $1,500 on our account. That cost us $660. Terms was $310, net $30. And as a courtesy to Shelton, $75 of the freight was added to the invoice, for which cash was paid by Waterworks. Okay, gang, so a couple of things are going on, so bear with me. We are on the selling side of inventory, and we know when we're selling inventory, we have to account for revenue. But we are also aware that on the selling side, we record our revenue at the net amount of the discount being offered. Therefore, our revenue must be recorded at the $1,500 minus 3%. However, for a courtesy, we also made a payment for the freight out, i.e. the shipping charges to get the goods out of the business. And so to keep things simple, gang, let's identify the revenues first. We know that we're going to credit sales revenue for the net amount. So if we take the $1,500 and subtract the 3%, that's going to give us a total of $1,455. We also know that we just made a courtesy cash payment for the freight bill of $75, so we're going to credit cash for that as well. Therefore, we're going to reverse engineer this back gain into the correct amount of our accounts receivable, which consists of the combination of the net amount of the actual sale as well as the courtesy of the freight bill, which gives us a total amount of $1,530. We're going to check the answer. Well done, gang. But remember, we're not finished because we have to recognize the cost of goods sold for this actual sale. So we're going to debit cost of goods sold and credit merchandise inventory for the $660. We're going to check our answer. Nice work, gang. September 29th, received payment from Shelton, less discount. Alright, gang. We can see on September 25th, we had made a sale for the net amount, including the discount, of $1,455. But remember, we also paid a courtesy amount of the freight out for the $75, which is also included in our accounts receivable. Since we are now collecting within the discount terms, we're going to simply make a recording by debiting cash and crediting accounts receivable for the total netted amount of $1,530. We're going to check our answer. Good job. And last but not least, received payment from Julian Company. So on September 15th, we sold some inventory to Julian on the account. No discount terms was involved. Therefore, we're going to record this like an ordinary collection on the account, which means that we're going to debit cash and credit accounts receivable for the gross amount of $3,300. We're going to check the answer. Bags all day. So there you have it, gang. A beautiful illustration of how to properly handle any transaction, whether on the selling or purchasing side of inventory for a merchandising company. If you learned anything from this video and that light bulb clicked and it brought you closer to chasing the bags with that accounting information, do me a favor and like, subscribe, and share the channel with your friends so they can chase the bags as well. As always, I'm Dr. Who, and I love the time and energy that you guys share with me, and I'll see you soon. Bags!